All right, everyone. So finally getting around to knocking this thing out a little bit. Let me get some settings here so I can make sure that we're good. All right. Um, all right. So we're going to be kind of jumping into where the last lecture left off, where I recorded it, I think last fall or maybe a little while before that. But anyway, we're going to kind of fill in the little gap here in my lectures, and hopefully this will prep you for the first test. And so let's kind of walk through things. And so we're going to kind of walk through prepayments or deferrals first. All right, so a prepayment occurs. Obviously, there's sort of an order. So whenever we have this adjusting entry situation, just as a reminder, it's a situation where the cash flow and revenue recognition or recognizing expense don't quite match up. And so we've got to do these internal adjustments. And so a prepayment or deferral is a situation where the cash happens first and then the expense or the revenue happens second. And so it's, cash first, then revenue or expense. There are several different types, but conceptually what ends up happening is that you have this payment that either can create a future economic benefit, and then you have an asset, essentially like as an example, if I prepay rent or I prepay insurance, well, I've now created this resource that I have going forward, whether that be rent or whether that be insurance, that I didn't have before. And so there's now an asset on my books. But what's going to happen over time is I'm going to start consuming that asset. And so again, over time, I'll end up consuming. Sorry, I'm going to do something over here. I'll end up consuming that asset over time. And as I consume the asset, of course, we know that when we consume resources, that's when we start recording expenses. And so that's really how we handle a prepaid expense. In other words, the initial cash payment creates an asset, and then we consume that asset over time. And as we do, we record an expense. And then with deferred revenue, it's sort of an opposite situation. So instead of dealing with assets and expenses, we're going to be dealing with liabilities and revenue. And so in a situation with deferred revenue, I receive payment. Instead of making a payment, I receive a payment. But now I have an obligation that results from that. So as an example, let's say that someone pays me for 12 months of magazine subscriptions or a subscription service to my website or whatever it might be. Well, I've received the payment, but now I have an obligation to provide access or to provide the subscribed, whatever it is they've subscribed to. And so in that regard, there's now a sacrifice that I'm obligated to make. And so there's a liability there. But eventually I'm going to make that sacrifice. I'm going to satisfy that obligation. And so as I do so, that's when I start recognizing the revenue. So as I make the sacrifice, as I satisfy the obligation, that's then when I would record the revenue. So again, two major types: prepaid expenses, deferred revenues. And now we're going to kind of start walking through some examples. And so from our example, there are four. One is that the prepaid rent. The other is office equipment, supplies, and then advertising. And we're going to kind of walk through each one. If you want to kind of pause the lecture here, one thing you could do is kind of calculate, we're looking for the end of January journal entries. And so you could sort of, given this information, you could try to think about, or maybe even do a journal entry, like in your notes or something like that, of what you think this would be or what this should be. And then pick it back up, and then we'll kind of walk through what it actually is. All right, so with the 6 months of rent, essentially, again, you receive, or you're making a payment on January 1st. And with that, now you have this benefit, you have this resource where I can use some space for the next 6 months. And then as I use that resource, I start recognizing that expense. And so if the total amount is $18,000, in any one of the 6 months, it's going to be $3,000. And so again, as we consume that resource, we record the expense. The name of that expense is rent expense. And of course, the resource that we're consuming is prepaid rent. Notice we're not recording cash. The cash payment was made on January 1st. We're not going to make another one. And so with every adjusting entry, we're going to be continuing to record rent expense and continuing to reduce our prepaid rent. And so as we post that to the T counts, you can see that our prepaid rent by the end of January reflects 5 months of rent rather than 6. And so, of course, the adjusting entry is also going to be updating our balance sheet simultaneously. All right, so the office equipment, kind of a similar situation. We buy the office equipment on January 1st, but in this case, we're going to get to use that for 3 years. Office equipment is a little bit different. If you remember this from class, we don't reduce the equipment account. Instead, we use this depreciation process. And so we record depreciation expense and we accumulate that depreciation expense against accumulated depreciation. And if you recall, that's a contra asset. And so, again, $20,000 over 3 years or $20,000 over 36 months means that in any given month, we're going to depreciate that equipment $556. And so, again, we record the expense as the debit, and on the credit side, we record accumulated depreciation. Again, we are sort of, if you want to kind of think of it this way, we're reducing the net office equipment. So office equipment never changes at $20,000, but this accumulated depreciation account will keep growing. But notice that it's growing. And if I can, let me just kind of do, where's my thing? No, draw, I think I want to draw. Notice that what happens here, it's probably too big. Oh, well, not the end of the world. Let's see if I can get smaller. Let's do this one. But anyway, what you see here, and I shouldn't be this picky. I know. I really don't want to draw. That's not what I wanted. That's something else. All right, never mind. Whatever. I can't decide what I want to do. I don't want to annotate. Where's this stupid? Bear with me. Where's my? Oh, it's over here. I got it now. There we go. All right. So what we have then is our, notice that this is still an asset, but it has a credit balance. So it is a contra asset. So as that account gets bigger, our net asset, our office equipment gets smaller. So if you could imagine, I have this office equipment with a debit balance, and now you have a growing contra asset that's going to have a credit balance. And so when we post that, initially, of course, the balance in the account is $556, but every month it's going to keep growing and growing and growing as we record additional depreciation expense. With the office supplies, hopefully this one's not too bad. Again, you can pause at any time and kind of try to do that on your own. That's going to bother me. Let's see if I can get rid of that guy. Clear. There we go. Good. Just checking. All right, blue's fine, whatever. This is going to bother me. Sorry. Little user error here. Kill that. All right. Sorry about that. So what ends up happening here is with our supplies, of course, we had $1,800. We do a physical inspection, and we're only left with $1,400. And so what ends up happening then, of course, that means we must have used $400. And again, just like everything else we've done, we're recording an expense because we're consuming a resource and then reducing the resource that we are consuming. In this case, that resource is our supplies account. And so again, we just continue to do that. Now for the next month, we'll do another physical count and we'll reduce it even further. So that's what the adjusting process does. But again, just as a reminder, notice there are no cash is never part of these entries. We're just recording these internal processes. In this case, the internal process of consuming resources. All right, so prepaid advertising, again, this is 3 months. But if you're going to try this one on your own, the only thing I want you to take note is the purchase date originally was January 15th. And now, of course, we're doing the adjusting entry at the end of January. So it's a little bit different, but not too bad. Again, the resource that we're consuming is prepaid advertising. And so the way we record that is by recording advertising expense. And of course, in this case, the full amount of $1,500 is, it's 3 months, but of course, in the month of January, it's only half a month, which is why it's $250 instead of $500. And so February would be $500, March would be $500, and then April would be another $250. Again, we record that. Notice we are consuming down here in the lower left. We are consuming our asset. And as we consume the asset, we continue to record our expense. Again, hopefully, in class we went a little slower. Hopefully these you can just sort of rewatch. Again, the key idea is with the original transaction, we create a resource or an asset, and then our adjusting entries, we record the fact that we're consuming that resource or that asset. All right, on the revenue side, rather than, again, creating an asset and consuming an asset, in this case, we are creating a liability and then we are satisfying that liability. And through that process, we are generating net resources for our company, in this case, cash, of course, above whatever cost it would take us to create it. And so imagine we're in a situation where 49er company has been paid $5,000 for help desk service, and we're going to figure out, okay, well, what happened on the original transaction, and then what do we need to do subsequent to that? And so with the original transaction, of course, you receive the cash, that's a debit, but now I have this obligation that I have to fulfill. In other words, there's this future sacrifice that I need to make. I need to provide this help desk service. And so I can't record that yet on February 1st because I have not yet satisfied that obligation. But over time, I'm going to satisfy that obligation. And as I do so, I'm going to record revenue. And so that first adjusting entry, again, it's for 5 total months. And so after 1 month, if we take the end of February, we've consumed, 1/5 of that, we've satisfied 1/5 of that obligation. And so that's when we're going to record our service revenue. And of course, we're reducing our obligation with every single one of those entries. And so after 1 month, the balance in the lower left again, the balance in our service revenue account reflects now 4 months rather than 5 months, because we only have 4 months remaining of providing service that we're obligated by the end of the month. Again, so adjusting entries, there's 2 types: prepaid expenses, create an asset, consume the asset. With the deferred revenue, you create a liability and then you satisfy that liability. All right, so then accrual journal entries. So if with the prepaids, the cash came first and then the revenue or expense came second. In this case, we have the revenue or expense first and then the cash comes second. So the order is a little bit different. Now, with most accruals, we already have a source document. It was part of our normal transaction. Like if I make a credit sale or I purchase something on credit, we've already kind of handled those. So accounts receivable and accounts payable, we've seen something like that. But that was still an external transaction. And so in that case, we really didn't have to make an adjusting entry because it was just part of our source document process, part of our external transactions. But there actually sometimes can be an accrual where it's an internal process. And so the times that happens is usually a situation where payments are at set periods or come at a fixed later date. So like salaries. So you might pay salaries at the end of every 2 weeks. Well, it's very possible that, and likely, that the end of a month is going to land somewhere in the middle of a week. And so if that happens, you need to accrue whatever work's been done to date, and then you would pay that after the fact. But of course, there's no external transaction here. It's just a process that happened. Your employees continued to work, but you have not yet paid them. Or an example might be if there's some sort of ongoing process where I'm providing service and then I bill and then they pay, sort of like service where there's help desk service, but I'm not really transacting. Maybe I provide service, consulting service for 6 months or something like that. And then they're going to pay me at the end of that consulting period. Well, I might recognize a portion of that as I'm going through time. But again, there's no external transaction. I'm not billing them necessarily. So there's no source document. Or something like, where there's a note, or from borrowing money or lending money, and there's a fixed payment or a fixed date where I'm going to receive payment in the future. Those are the things that you're going to look for. Again, these are not necessarily quite as common, but they do still exist. All right, so let's look at our example. There are really 2. And one we had employees, and the other one we had a note. And so, we had a situation where our employees do continue to work. So the last time we paid them was like January 15th. And so now they've worked the second half of the month and haven't been paid. We're just going to kind of give you the amount of $13,600, and we need to record that amount. The second thing is with the note. We know that we're going to repay the note and interest 9 months from the date it was issued, but the process, as we've talked about, the second I start borrowing, now I'm starting to incur that interest expense and I'm starting to owe some interest. And so that internal process is happening all the time until I finally, pay it off. And so we need to record that the interest is accruing as time passes, even though there's no external transaction until 9 months into the future. And so this is an internal process where we need to accrue that expense. And so for the first one, hopefully this isn't too bad. Again, you got to think about what obligation have I now created with related to the work that my employees did. And so in this case, of course, the work that they did is related to salaries. And so now I owe them salaries. So again, creating the liability. And then now we have the expense related to that. All right. So again, we're recording the fact that my employees have worked. And so now I owe them some of my resources. So through their work, they've consumed those resources, or at least they have a right to those resources. And now I have an obligation to pay them. And so now by the end of the year or by the end of the month, your total balance is $27,200. And so it's 2 months of 4 weeks of salaries rather than just 2 weeks. Of course, now we have this payable that we're now obligated to pay. The second one is the note. If you remember the terms, I think it was a 9-month note and $30,000. So we borrowed $30,000 at 6%. It was a 9-month note. I want you to go ahead and try to calculate the interest expense on your own. So pause the lecture, calculate that interest expense, and then restart the lecture once you've done so. All right, so most students, if they got it wrong, it's really the error was in this term right here that I am circling. And so it's important to understand that when you see 6%, that is an annual percentage rate. So it basically means if I owed this money for a full year, I would owe 6% interest. But of course, at the end of January, I've only owed the money for 1 month. So 1 out of 12 is how we scale the interest. And so 1/12 of the annual interest is how much we incur in the current month. And of course, the obligation now is interest payable. And now basically the consuming the resource eventually that we're going to have to pay is the interest expense. Again, we update it. This is one where neither one had a prior balance. And so we just update that. And then the final one here, sorry, the dog barked a little bit there. The final one here is accrued revenue. This is a new example. It's not in the book. Sorry, my daughter just walked in and the dog's going nuts. Hopefully it's not too loud. Anyway, so we're going to kind of take the other side of the note transaction to understand how we might accrue revenue. And so if I'm a bank and I lend that money, so I lend $30,000, same terms, 6%, and it's a 9-month note. But now instead of in the case of 49er Company, they owe the interest. For Panther Bank, the interest is owed to them. And so they're on the other side of this transaction. And so the nice thing is the numbers are the same, but the accounts are a little bit different in that instead of having interest expense and interest payable, we're going to have interest revenue and interest receivable. So Panther Bank now has this asset. They have this additional resource, and the resource is this receivable. Eventually, they're going to be paid. There's a future economic benefit from the bank's perspective. And of course, because they've lent the money over that month, that's the amount that they've earned, the 150. All right, so we are going to pick the rest of this up in one additional lecture, but for now, I'm going to stop recording.